Unfortunately, I was wrong again when it comes to mortgage rates, and because of that, my stance has started to change. Over the last 6 months or so, I've been a big believer that you would see interest rates improve significantly as you saw inflation numbers come down. And while we have seen inflation improve and interest rates improve a little bit, interest rates at the time of this video are sitting somewhere around 7.17%, which is the highest mortgage rate that we've seen in the last 6 months. And a lot of it has to do with the bond market, which is experiencing more volatility than normal due to the debt ceiling debate, which in theory is causing traders to be more defensive, especially as they head into that holiday weekend. And in turn, we've seen mortgage demand drop as interest rates have crossed back over that 7% threshold, which is exactly why we've seen mortgage applications drop by 4% to purchase a home over the past week and down nearly 30% year over year. So if interest rates follow inflation and inflation in turn is starting to come down, then why aren't we seeing a larger improvement in interest rates? Well, there's actually two different things going on. One, again, we have a lot of volatility in the market due to the debt ceiling talks, but on the other side, we also have a lot of mixed data when it comes to employment and inflation data. So the Fed has been very specific in what they're looking for in order to pause or pivot when it comes to rate hikes. And while a lot of people like myself thought that the May rate hike was likely to be the last, Fed traders are fully pricing in an interest rate hike once again. And that's largely because the Fed is really watching two things. Like I said, they want to see employment numbers get worse. They want to see unemployment high. That shows that the economy is softening, on top of seeing inflation trend back towards their 2% target. But what we've seen is exactly the opposite. While we are seeing U.S. jobless claims tick up, we're also seeing the previous week's data revise lower, showing that the employment numbers weren't quite as bad as originally expected. And on top of that, the Fed's preferred measure of inflation, PCE, showed that inflation rose 0.4% in April and 4.7% from a year ago, which is 0.1% higher on the month-over-month and year-over-year numbers when it comes to inflation. And despite the higher inflation numbers, consumer spending held up and personal income increased. Spending jumped 0.8% from the previous month, while personal income accelerated 0.4%. So essentially, this is showing the market that the economy isn't nearly as bad as a lot of people out there believe it is. And because of that, immediately following the report, market pricing swung to nearly 62% of traders out there expecting the Fed to once again hike the Fed funds rate in the June meeting, compared to just 17% 1 month ago. Now, I'm on the flip side when it comes to the idea that the economy is doing really, really well out there. I believe that one reason that we're not seeing employment numbers rise nearly as much is because we have a lot less workers out there in the workforce, and there's a lot of available jobs out there, which means that if somebody loses their job, they're likely in a position to go find another job relatively easy. And therefore, there's a really good chance that we don't see employment numbers rise like we have in the past. Now, before we dive into that, I want to take a minute and ask a favor. Do me a favor and hit that thumbs up if you find any value in my videos at all. And also help me accomplish my goal of hitting 100,000 subscribers on this channel by hitting that subscribe button. Now, whether or not the Fed decides to pause in June or not doesn't really decide the direction of interest rates anytime soon. In fact, at the moment, you have Fed's Kashkari saying that a June pause on rates wouldn't necessarily indicate an end to the hiking cycle, basically saying that there could be a pause in June, but that doesn't necessarily mean that future rate hikes are off the table. In fact, it looks like the Fed is somewhat divided on what interest rate hikes look like. In their previous notes from last month's meeting, it said that Fed officials were less confident on the need for more rate hikes, as they were actually divided on where to go with interest rate hikes, with some members seeing the need for more hikes, while others expected a slowdown in growth, in turn removing the need to tighten further. So let's take a minute here and talk about the Fed's division, if you will. If you remember back about a year and a half ago, the Fed largely believed that the inflation that we were seeing was primarily transitory, and therefore they didn't do anything with regards to quantitative tightening. In fact, they were still infusing the economy with money, and that's primarily because the data that they were looking at was lagging. It wasn't actually showing in the numbers yet. Well, we actually have a similar problem now, where the Fed is looking at the market, but they're looking at numbers where the data isn't reporting correctly because the numbers are lagging. Therefore, it looks like the economy is doing much better than it is. It looks like housing is doing much better than it is. And while the PCE portion of shelter is still showing up at 8.4% year over year in April compared to 8.3% in March, that shows that shelter is getting worse. But we know that rent shelter data is actually coming down, and it's a lagging indicator. And because of that, I don't give a lot of weight to what the Fed thinks, because quite frankly, I think they're looking at the wrong information. And that's because we know that asking rents are softer year over year, showing that rent growth is continuing to decelerate, showing that both CPI and PCE are currently overstating the actual inflation. So how does all of this end up affecting mortgage rates? Now, at the beginning of the video, I mentioned that I was wrong when it comes to mortgage rates because I believe that interest rates were going to come down a little bit more significantly as we started to see the inflation data improve. But we've had two different problems. We haven't seen the inflation improve nearly as significantly as I thought we would because of some of how these lagging indicators report. On top of that, we have the volatility with the debt ceiling and those sort of things that we mentioned earlier. Now, let's be clear in what I said a moment ago. I thought that interest rates would improve somewhat significantly, meaning that I thought interest rates would probably be somewhere in the mid 5.5% range. And while we have seen interest rates move back towards those numbers, we've actually seen them spike and move the other direction. So with that said, I'm currently in the camp that interest rates are likely going to stay higher for longer because I don't believe the unemployment numbers are going to rise significantly enough for the Fed to take their foot off the gas pedal. In addition to that, I think it might take a couple of more months for the shelter data to start to reflect correctly in the numbers where the Fed will actually admit that inflation is coming down somewhat significantly year over year. So like I've said, when it comes to house prices, you're not going to see a meaningful up move or a down move in house prices. I think it could be really similar for interest rates, where you see interest rates move up and then you see them move back down a little bit, and you're more or less in this trend for the foreseeable future. Now, with that said, there are some famed economists out there like David Rosenberg saying that he believes that home prices will fall further as buyers retreat to the sideline and the Fed stays hawkish, primarily due to stubbornly high mortgage rates. But I'm in the camp that home prices are going to stay stable, primarily due to inventory numbers. While inventory is still up year over year, we're currently sitting somewhere around 424,000 homes nationwide. And based on the current trend of new listings not really coming to the market, there's a really good chance over the next couple of weeks that inventory levels are going to go lower than 2022 and possibly even 2021. Now with that, I want to take a minute here and actually talk about the housing market. The most recent data that we got showed that U.S. pending home sales were flat in April, but down nearly 20% year over year. Now, pending home sales is a leading indicator, kind of shows you the direction that the market is going. And while I do believe pending home sales are likely to stay pretty strong here over the next couple of months, there's a really good chance that you start to see pending home sales move lower towards the end of summer, largely due to interest rates moving higher. So what about new construction? What we saw in April is home buyers flocked to new construction, causing it to hit 13-month highs. But at the moment, there's only about 70,000 homes that are actually completed when it comes to new construction. So a lot of people out there believe that there's this large amount of property that's completed that no one's actually out there buying. And that's simply not true. The large majority of new construction is currently under construction, which represents somewhere around 650,000 homes. But with that said, a large majority of those homes are actually under contract. But nevertheless, as the market slows, there's a really good chance that some of those properties are going to fall under contract, and new construction is still likely to be the best deal in the market as we head into the latter part of 2023. Now, with that said, I know there's a lot of people out there waiting for the next shoe to drop, if you will, with regards to inventory. A flood of sellers coming to the market, a flood of foreclosures coming to the market, and that's not likely to happen, largely due to these two reasons. One is interest rates. The large majority of people out there have an interest rate locked in much lower than where we sit today. In fact, if you look at this chart here, you can see that there's a very small percentage, maybe 10% of people who have an interest rate above 5%. And that's exactly why sellers aren't likely to list their homes. And for those of you out there talking about the foreclosures, well, here's a chart showing the loan to value by first lien, showing you that nearly 95% of the market has more than 10% equity in their property. In fact, you have nearly 50% of people out there that have a mortgage having a loan to value less than 60%. On top of that, nearly 42% of Americans own their homes free and clear. So the reality here is that you're not likely to see foreclosures increase. You're not likely to see inventory increase anytime soon, which means that if you're out there looking to buy in this market, instead of focusing on the top or the bottom, you should be focusing on whether or not it's the right time in your life.